Morning.
Tony, great to catch up. We have had 48 hours full of central bank speak. Do I sound tired? What was the headline?
Well, I think you were all just talking about it. In fact, Lisa just said jobless claims are still elevated at 800,000. And a key comment this week from Lyle Brainerd, who, by the way, could well be the next Fed chair next year. Keep that in mind. She spoke to the idea that even though we've seen improvement in employment, that it does not yet fit the Fed's new definition of what constitutes maximum employment. Remember, last August 27th, the Fed changed its framework to say that maximum employment must be broad and inclusive. And so that's a broadening of the definition. That means even if there's a recouping of the 10 million additional jobs that have been lost, that have not been regained, that the Fed will be looking at different yardsticks to decide whether or not it should raise its policy rate. And that's an important element and wrinkle in the central bank world.
Tony, congratulations on your new book out. I want to go back to Steigum's 1,000 pages on the short-term market. Tony, well, 1,200, excuse me. Sorry, missed that. I didn't get to the last 200 pages.
The last 200 were hard.
Tony, stay with me here. Okay, the bond market, when it moves, moves. Like in the spread market, we move what's called, folks, red zone to green zone, up and down quickly. We're in the middle of that right now, Anthony Crescenzi, where we're moving rapidly on spreads. Is it a normal red zone, green zone abrupt move, or is there something different this time?
Oh, well, it is different than the 2010s. The 2010s is the wrong analog for the current period because of the degree of experimentation that's occurring between the monetary and fiscal authorities. Experimentation meaning the extent to which the central bank is enabling the fiscal authority to drop money into the economy in massive quantities. So that's different. But Lisa mentioned the 7-year auction, and that's an important concept in this, and the steepness of the curve. Bond managers love a steep yield curve. Bond investors should love it generally. The 7-year note on the surface is yielding 1%. It is 1% yield, but the 6-year note is 80 basis points. Let me give you some strange bond math. There's a 20 basis point difference. So what does the 7-year become in a year? A 6-year. So if today the yield is 1%, next year then if the 6-year is 80 basis points, it'll fall in yield. What happens when yields fall? Prices rise. By how much? Bond math is 7 years duration times that change in yield, 20 basis points. That's 1.4 percentage points. So a 7-year, the total return in a year, if yields just stop moving, would be 2.4%. And so there's a cushion is what I'm saying. Per unit of duration is 30 basis points per unit of maturity of cushion to help a bond manager, bond investor today. Now that cushion is important for the equity investor too, the credit investor, the investor in the private markets. If they are thinking about bonds and they're worried about the move, that's a bit of insurance. It's similar to saying that you buy a 7-year today at 1%. That's not quite attractive. But I mentioned the total return idea. Yeah, it is still has diversifying characteristics that enable an investor to take risk in the equity market, in the credit market, in private assets, and so bonds still have a place in a 60-40 split between bonds and stocks context. We think there's still hedge value. So from that context, it's still important. The steepness is important in terms of what's happened.
Tony, I got to say, it does show you, though, where we are in the cycle, that we're talking about bond math and such granularity to eke out a 2%, 2.3% return based on where yields are. So it does give you a sense of just where we are in the low interest rate environment. I'm wondering, on a broader level, though, this rise in interest rates has really come from the rise in real yields. That's basically not the inflation expectations. And I'm not sure what to make of this. I mean, we're not seeing inflation expectations go up in tandem with yields. What's the message?
That's important, Lisa. In fact, I wrote myself a note. One of the top things I wrote was real yields.
Good handwriting.
Good.
So you picked up, you picked up on an important point. The important thing that's happening is that the rise in real interest rates is not affecting the stock market. It's not affecting the credit markets. It's not affecting markets more broadly. Financial conditions are still loose. It's another way of saying that the pain threshold has not been reached, which is to say that yields then could go higher because rising real yields, higher yields, tend to act as a automatic stabilizer, self-stabilizing mechanism, in the sense that as yields rise, it causes equities to fall and then yields stop rising. And so the fact that real yields are having no impact is important. So you want to watch and see where it is that the rise in real yields starts to influence other assets, because that's probably the point where the rise in yields becomes self-stabilizing. And it's not there. It might be in the high 1% range, closer to 2%. For all we know, so long as the equity investor, the credit investor thinks that 2% is it.